Where do we lie on this investment spectrum? We want to be justifiably close to as secure as a treasury or a money market. That's kind of the risk profile that we want to sit in. So that's how we decided to structure our funds.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is David Little. He's a co-founder of Crown Capital Resources. It's a thriving private lending firm in Texas. After a 15-year career as a petroleum engineer, David pivoted to lending, leveraging his analytical expertise to scale Crown Capital from a personal investment vehicle to managing $14 million in capital. And he's here to share how he built a sustainable, low-risk lending business and what drives his success in a highly niche market. So, David, happy to have you here. How are you?
Good. I'm doing well, Neil and Clint. Thank you guys for having me. I appreciate the opportunity.
Absolutely. So, David, before we dig into a little bit more about your background, maybe you and I could lead the audience in a rousing rendition of the Aggie War Hymn. I'll start.
Please don't.
Hullabaloo connect.
We're going to lose both of our listeners.
That's funny.
So, listen, these two knuckleheads have something in common with Texas A&M. David, let me ask you this. You know, when I built up a small portfolio of single family homes, did it the wrong way, then small multifamily Airbnb properties. It was extremely laborious. And I was looking hard for what is a more passive investment strategy that I could find either as an active or a passive investor, either to operate it myself or to put money in. And the three things that kept coming up when I was asking the more successful investors that I was looking up to was three things. One of them was self-storage, which is the direction that I ended up going. The other one was mobile home parks. And I was already burned out on tenants because of the Airbnb thing. So that wasn't right for me. But the third thing that consistently came up with the older successful investors that had the lifestyle and the time, financial, and location independence that I was looking for was hard money lending and note lending. And for me, I didn't start in that direction because I didn't have the seven figures it took to go that route. I know that it's not necessary to have that money. You've been successful in raising money and you've got 14 million in capital under management, or at least at the time of this bio. It's probably higher than that now. So that's a strategy it's been around from the beginning of my journey of really diving into passive investment strategies. So if you will, please tell us a little bit about yourself. Tell us a little bit about the lending world and how you got into that space.
Sure. So the arc of how I ended up in lending is actually, it's a 7-year journey, really. But I'll backtrack a little bit first. My background is I've got an engineering degree from Texas A&M. I actually worked as a petroleum engineer for 15 years. And then throughout this 15 years, I, similar to yourself, Clint, I did from my first year in the industry, in the oil and gas industry, I started diving into real estate as well. So I was always doing different ventures. And throughout, a 7-year period, I was able to try a lot of different things. I built up a rental portfolio. I had tried Airbnb. We did some raw land development. And it wasn't actually until 7 years into the real estate investing that I did my first hard money loan. And me and my business partner, like the co-founder of Crown Capital, we got together, pooled our own money. And it only kind of happened fortuitously. We had an investor friend of ours call us and say, "Hey guys, I've got a house I want to flip. I don't have any money. Can I get some money from you guys?" And so we did that. And the beauty of it back then was it was the only thing that we had done in real estate that was compatible with the W-2 engineering job as well. So that's why basically for the next 7 years, we continued doing hard money lending just on nights and weekends. And so it really was until for the first 5 years of the business, it was our own capital. And then roughly 2 years ago, we started having friends and family ask us, "Hey, you guys have been running this business for a long time. What sort of returns would you give me?" So we ended up with a 10% interest structure paid out monthly. And we brought friends and family, and that's when the business really scaled. And it scaled so much so to the point where in early 2024, this year, I realized that this business is now outpacing my W-2. And also there's a lot a lot higher potential in owning your own company and what the steering looks like and actual true time freedom. And so I actually made the jump. I resigned from my engineering role after 15 years, just about 6 months ago.
Congratulations.
Wow, congrats.
Yeah,
thank you, guys.
That's amazing. I left medical sales after 16 years in 2022. So, it's fairly new for me as well. So it's a big step. I'm proud of you and I'm excited for you. It's been huge for me.
Before we go on, just for audience members who are maybe not familiar with the term hard money lending, can you give them a basic understanding of what that is?
Absolutely. So there's like half a dozen synonyms that are used for hard money lending. You might say private lending, hard money lending, note lending. Some people call it gap funding. Essentially, the key differentiator in my mind is it is hard money lending if you own a first lien position on a physical asset. And that physical asset might be a single family home, a multifamily home, a commercial piece of property, or a piece of land. But what differentiates it is as you give the loan out, it's hard money because there's a hard asset that you have a first lien position on. So it's a pretty broad category, but it has to check that one box.
And what differentiates that from a standard mortgage?
Yeah. So a standard mortgage would typically be, I'm going out and I'm taking a 15-year or a 20-year note. The hard money lending space is custom built. It's really a kind of a niche lending product, primarily for people who are going out and flipping properties. So when we underwrite a residential loan, we underwrite it for a 6-month term. And what we really shoot for is for these people, for our client base to acquire, renovate, sell the property within 3 to 5 months. So it's a very, very short duration versus a mortgage, typically 5+ year duration.
I'm going to make a couple assumptions here and then ask some follow-up questions depending on whether or not I'm right. So the lion's share of your investing it's wholesalers that are either flippers that are either wholly sourcing their own deals or they're using wholesalers and they're finding deals that are coming to market that are below market value. Usually they have some requirement for forced appreciation through renovation or whatever it may be. They're going to get their hands on the property. They're going to jump in. They're going to turn this property in a couple months. They're going to get it up. They're going to list it either with themselves or list it on the market. And then when they sell it, obviously you're getting paid out. And are there interest only payments during the time period that they have the money, or are they just paying it all off at the end? Is there a potential for extension for 1-3 months, whatever it may be, depending on what they're falling into? And then I'm assuming you're probably like 12% in 1 or 2 points, and maybe they can get a little bit better the more deals they do with you. And then you're probably at a maximum of, are you loaning on the after repair value of the property? So you're willing to give them money for the purchase and the renovation up to a certain percentage, certain LTV of the ARV?
Yeah. Okay. A lot of built-in questions there. I'm going to try to remember them all.
Well, yeah. So I'm a flipper and I'm coming to you and I'm like, hey, I've got this flip. I don't know if it's good or not. I think it's going to be good. Help me underwrite it. How much money can you give me? How often do I have to pay it back? Like I'm a first time flipper.
So your characterization about the overall business model from the residential space is exactly right, Clint. People come to us, whether they are the wholesalers, whether they are the flippers themselves or brokers. They send us a property and they say, hey, I'd like to take a loan out on, 4114 Castro Street in Houston, Texas. We turn around and we say, hey, that sounds great. Can we get the purchase contract? Can we get your renovation breakdown? Let's take a look at a basis of design of what the actual finished product is going to look like. And then we internally underwrite that product. And we say, hey, this looks good. I think at the very end of the day, once the renovations are in place, you'll be able to sell it for $300,000. And so our max loan to value in that is 70%. So you take 70% times 300,000. So the maximum loan that we're willing to give you is $210,000. And we typically require a minimum of a 10% down payment. And so let's say we proceed with that. They say, that sounds good. For easy math here, we'll stick with the $210,000. It's $150,000 purchase, $60,000 rehab. So we come to closing. Crown Capital comes to closing with the $50,000. And then we hold that $60,000 back in escrow. And so what we do the origination side and we do the servicing piece as well. So as that loan is going on, they have to have the capital for, the upfront closing costs, the down payment for our loan. They also need to have the capital to start the renovation as well. Because what we do is we will reimburse retroactively. So let's say 60,000, before the loan initiation, we split that up into, let's call it 4 payments. So based on that renovation schedule, everything, 25% of the rehab needs to be done, sent to us, fully documented, and reviewed. And then we will retroactively reimburse $15,000 at a time, as an example. And so the goal with that is, you are in an over-collateralized position at the time of closing, and you maintain that over-collateralized position throughout the entire loan.
Mm-hmm. Okay, got it. So how many of these investors are, so they're not doing no money down deals? Like they have skin in the game. They've got money that's out there because you're releasing money to them after the equity has been injected in the project. Is that right?
Yeah, that's correct. That's correct. Yeah. And there are instances where we would do, no money down. If somebody owns a property free and clear and they're willing to cross collateralize, that's something we would consider. Another instance of that happening is somebody who's essentially doing maybe a cash out refi. So if what we would do in that case, instead of saying, hey, we'll do a max 70% loan to value, we'll give you 50% loan to value. And then they can do a cash out with zero money down. So in that case, I own a $300,000 rental property free and clear. I need $150,000 out of this property within 3 business days, to go maybe finish up some other properties or maybe to acquire this screaming deal that I found. In that case, we won't do a down payment, right? Because we got a first lien position at 50 cents on the dollar. Right? That's a great position. That's a great place to be in.
Now, this is a little different from my experience with a typical hard money loan, which is typically often, you'll be required to have some sort of skin in the game, let's say 10% down. And then that hard money loan is 100% being either given to the rehabber or being given to them in draws. There'll be enough to basically acquire the property, and then for the renovation, it may just come in draws. And then I've heard it sometimes where it's 100%. Hey, we're going to give it to all of you, but you're responsible for monthly. You're going to be paying that monthly.
Yes.
Correct.
Yeah. There are some lenders that choose to do it that way. We do not choose to do it that way because in my perspective, my role as a business owner, is first and foremost, I'm a fiduciary for my investors. And that is, of course, now the third party, this is the limited partnership that encompasses the fund, but also to consider that, I myself am one of the largest shareholders in the fund as well. So, the incentives are very much aligned. But when I think through that, my business partner and I thought and said, we want to structure this in the lowest risk manner possible. And the way in which to do that is, number one, you have to service everything in house. And number two, you want to make sure that they're paying the monthly interest payments. You don't want to do that prepaid or kick it on the back end. And you want to make sure that you document and process the entire renovation schedule so that you can tell, you kind of have that cadence of accountability and that health check. Hey, there's progress being done on this house. I'm seeing the pictures. I'm seeing them, the mechanics doing waivers, the video proof, the invoices. This loan looks to be progressing in the right direction, because the nice thing about doing all that in-house is that you can get a lot of leading indicators when things aren't quite going well, right? So if there's no work being done on the project, for example, we'll reach out and say, hey, what's going on? Maybe they have a cash issue or another problem, but you wouldn't otherwise have that kind of leading indicator if you weren't doing all those things in-house.
Yeah, you're keeping your finger on the pulse of what's happening with the project.
Yeah.
I got a question for you, and I don't want to come across as throwing rocks at you while you're mowing, because this is your space, and I know that I'm not attacking you with this question, but one question I do have is when it comes to flipping properties, we've saw the scenario in 2008, especially where the last guy got stuck holding the bag because it was a massive market correction. And I don't anticipate we'll ever see a correction like that again, at least not in the current economic trend that we're dealing with. Like, we're having some rocky times and there's some economic headwinds, but not a total collapse of the banking system. So, like, within reason, you're at 70% LTV of the ARV, and you're establishing that the equity is being built as you're injecting the money's going out to them after they've added more than that in value to the property. So I see how you're protected. But the question that I have is, how many of these deals have you done, and what's the default rate?
We're actually really proud. We've been in business for 7 years. We have funded, over 150 deals, over $40 million. We have had, in that entire time, we've had one formal default, one formal foreclosure.
Okay. And in that scenario, you get the property back again, well below the ARV, even if they stop halfway through renovation, right?
Yeah, that's correct. So that was the scenario where, and it just recently happened. It happened on August 6th. I remember it was like burned into my mind because it was our first one, right? And yeah, so essentially the story with that one is the borrower passed his primary term. So we reached out to him for an extension payment, and he didn't send it over and didn't respond. That unresponsiveness lasted a few weeks. So within a few days, we had gone ahead and sent a demand letter. And the reason you want to do that is because that starts the clock towards the foreclosure process. Now, the vast majority of the time, you send somebody a demand letter from your attorney, they're paying it within 1 or 2 business days. But this particular client didn't. And then in Texas, it's a really quick process. It can be 53 days. And the nice thing about being in a non-owner occupied, non-homestead investment property is that there's really nothing stopping you from foreclosing on the property and taking it back over. So this particular house, and that's correct, there's no tenants in there as well. So this particular property, we ended up taking over for right around $270,000. That was our note on it. We ended up needing to finish out a few items, so we got a contractor in there. So full from demand letter to taking over the property was roughly 60 days. We needed to get a contract in there. That took a few weeks. Put it back on the market we put it back on the market very aggressively. I believe we put it back on for $299 and got multiple offers, the highest of which was $325. So that property's been sold, and that was all good. And from our perspective, our investors didn't even feel or see, or that didn't hit their interest payments at all.
Yeah. From the outside perspective, and this, I guess it doesn't really matter, but why did they fail on the project? And, what did you guys learn from that moving forward with your business model? Yeah.
This was a case where there was a lot of other issues that he was having. I mean, we found out he had back taxes he owed thousands of dollars to the electric company and other utility companies. I'm not sure exactly what happened with him personally, but it seemed to me like there was just kind of a business and life implosion. And we were just collateral damage. And it was a weird scenario because we were very helpful the whole time. We were telling him, hey, we don't want to foreclose. Let's just make the payment. And for weeks we would get, the calls of, hey, I'm literally driving to the bank right now. I'm going to go make the extension payment and nothing. So we were more than happy to work with him. He just didn't uphold his end of the bargain.
Yeah, unfortunately, you do this long enough, then you lose faith in humanity sometimes, and that's a shame, but it's the reality. Before I have questions about. So I'm also a limited partner investor. We are general partners. We have money into every self-storage deal that we do, but I also have multiple self-directed retirement accounts that I am not allowed to put into our deals because I'm a general partner. It's illegal. It's called commingling. So we are always on the hunt to look at what other offerings people have. And so I want to talk to you about some of the economics of your fund. But before we do, I know that about 20% of what you do is gap funding and stopping the bleeding on the commercial side of things in the economic headwinds that we're facing. So I know that the fix and flip is the lion's share of the business that you're doing, but talk about the other 20% of the business and what you're doing there.
Yeah, I'm happy to. So this has actually been a growth sector for us. For the longest time, we really wouldn't touch commercial. But like you said, there's been a lot of, for lack of a better term, kind of distressed financing in the commercial space. And so we've gotten a lot of opportunities lately. We are substantially more conservative on the commercial side than we are the residential side. Like I mentioned on the residential side, our max loan to value is 70%, right? And that value is a stabilized value. It's an after repair value. The commercial side, we are 50% loan to value on an as-is appraisal today. So the first thing that happens when somebody reaches out for a commercial note is that we go and send our appraiser out there, 10 days or so. He can get us back a report, and he gives us an as-is value, and we go back to the client and say, we'll lend you up to 50% of this. And so we've been able to make some really great deals over the last 18 months in the commercial space. And it's one of those things where I'll underwrite something in-house on the residential side because I can get my head around valuations. I understand how to run a CMA, all those things. The commercial side is a different beast. So we're relying on third-party appraisers. We're being extra conservative on that. I think all in right now on our commercial side, we're at about a 45% loan to as-is value. So the idea there is, if any one of those ever defaults, we're going to be, we probably honestly wouldn't even take it to the bankruptcy option. We'd probably call some of our investors and say, hey, we could potentially acquire this building on 50 cents on the dollar. Are you guys interested in kind of doing a sidecar vehicle here?
Yeah, almost a purchase lease back at that point in time.
Yeah. So it's been a growth phase for us, and I love those loans because they're very, very low risk. And there seems to be more and more of them.
In general, what is the distress that you are trying to solve for these commercial deals?
Yeah, well, the most recent one actually closing next week. It's not actually a distressed commercial building. It's a owner operator, owns a construction company. And what he wants to do is he owns a property out in Manly, Texas, free and clear. And what he wants to do, he just needs some capital to basically build out his warehouse and facilities. He wants to build an office space onto it to house all his people there. He wants to build an additional storage facility. So he's pulling out the cash to actually expand the building. And then his game plan at that point is to, reappraise it and then refinance it with a long-term lender. We've had other ones where it was a owner finance deal on a handshake agreement, and the owner decided that they just wanted to be paid out. So that was the situation where that individual needed to close within 10 days or he was going to lose the building. And then other times it is kind of what you guys said where, hey, sometimes it's hey, I'm acquiring this building for under market value. It's in the foreclosure process. This is one in warehouse in Houston. And, it's going to court in the next 14 days. I know I can get it for this number. Would you guys do this loan? So the commercial, I know we talked about this before we started recording, Neil and Clint, but the commercial ones always kind of got a little bit of a story to them. And they're actually, to be honest with you, kind of my favorite ones to work on just because they're unique. A lot of what we do is, it's just so turnkey. We kind of go finance the same flip over and over and over again, but the commercial ones are a little bit more fun.
Yeah, that was my next question. I was like, you're kind of rubber stamping these fix and flips, and then you see a commercial come across and you see the valuation and you're just like, boy, I hope one of these guys defaults. This is going to be not really, you're not wishing anything bad on anything, but like you're very secure because like with the residential property, what's the valuation, right? You know how to run the CMA. The comps for a residential property are the bricks and sticks and what the neighbor paid for theirs, right? It's very cut and dry. It's bricks and sticks and what the ones on either side of the street paid. With commercial, it's so different because the valuation is typically based upon an EBITDA multiplier or most likely a net operating income, right? So if they can increase their net operating income, decrease their expenses, you can wildly fluctuate the value of the property there. And because you can fluctuate it so fast, I think that a lower LTV is a much safer place to be. And that was one of the things the question I had was like, okay, what kind of terms are we talking about? Because this is a short-term injection of cash for somebody that's building something out. It's the equivalent of a HELOC on a business, and you're giving him the money to expand and add housing and things like that. Are you in the same 6, maybe 12-month term here?
Yeah, I should have clarified that at the beginning. Our residential terms our terms for residential are 6 months. Our terms for commercial are 12-month terms. And to answer a question that you did ask earlier, we do always offer extensions, as well. We charge them a point for a 3-month extension, but that's always available. Essentially, these are interest only loans. such that, you have the amount of time to finish your project. And then as soon as the payoff occurs, there's no prepayment penalty or anything. You're out of the loan.
All right. So that's, your 20%, this commercial distress type properties, 40% just base hits, fix and flips left and right. What does it look like for the limited partner investor that's going to drop, 100, 250 grand in whatever? You said 10% and that's monthly payments. Is that right?
Yeah, that's correct. So we set up actually June of this year, we hired a securities attorney and we set up a 506c income fund. And so the way that we set up our fund is there's essentially two classes, 0 to 250,000, and you make 9% pref return. And then 250,000 up, you make 10% pref return. And the returns are 9% and 10%, accordingly. And the additional option that people have as well is to say, because of the structure that we set it up as, if you want to reinvest your return, you can do so monthly, which actually, increases your ROI. And so you can choose to take that payment every month, or you can choose to basically let it add on to the capital, the principal. And then in that case, you would have monthly compounding on that amount.
Yep. Compounding interest is obviously that's the next step, right? There's a couple different debt funds out there, but if you don't need the money right now and you can lean into that compounding interest, that's obviously a much more attractive thing in the long run.
Yeah. And we found, as you could probably imagine, a lot of the people who are with us that have self-directed IRAs, most of them have chosen the 100% DRIP option, which is DRIP stands for dividend reinvestment.
Yeah. Minimums?
50,000.
50,000 up to 250, 9 pref, and then a 10 pref, and you get monthly distributions. Obviously, if you're using SDIRA, first of all, this makes a lot of sense because it's a debt product. There's no UBIT or UDFI, so you're not incurring taxes there. And then it gives you the option of basically reinvesting the dividends so that you get compound interest. Because if it gets paid out, you can't benefit from that until you're 59 and a half anyway. So it's just going to sit in your account, not doing anything. You might as well put it back to work. What are your liquidity options in terms of if I'm not using SDRA or I am, and I found something else I'm looking at, what is your liquidity option, and is it limited based upon how much capital I have it? Because if I give you $2 million, I'm not expecting to get that back in 90 days. If I hey man, just a heads up, I'm going to need this back in a couple weeks. So how does that work?
So this was actually something we spent a lot of time on, because when we wanted to be very thoughtful as to our investment product that we're offering our third-party passive investors, what does it necessarily compete with, right? And so when I think about it from as a spectrum of investments, and maybe on the very far end, on the left side, you have cash, treasuries, CDs, where you have lower returns but immediate liquidity. And then on the far opposite end, you might have something like being an LP investor in a syndication, right? Like maybe a self-storage deal or a multifamily build out, where it's potentially you're looking at 5+ years of hold periods. We view our product to be right next to treasuries and CDs. So the idea is we want you to have very high liquidity, but essentially double the returns of a CD or a treasury note, et cetera. So our lockup periods, I mentioned those two classes, class A1 and A2, which would be 10% and 9%. That is 6 months lockup period. And then class A2 has no lockup period. So we want it to be very liquid. Now, keep in mind too, that those are contractually kind of how long we could keep that capital back. But operationally speaking, we have had investors, things happen in their life, like I want to buy a personal home or I need to pay taxes or whatever. Operationally speaking, historically speaking, we've been able to move people's capital back to them within about a week.
Yeah, and there's no reason not to, because you got to pay interest on that anyway. So you rather get it out.
That's right. And so we want to maintain that ethos of, hey, this is a highly liquid investment vehicle. This is something where you can move in and out of with fluidity. It's not going to be this huge operational headache. It's an email and give me a timeline and we're going to make it happen.
All right, I love all that. Let me ask you about one of the things that you can't control is that your money is only making money when it's deployed. Your money has to be out there working. Somebody has to have found a deal. They have to be ready to move forward on it. The supply chain problems or the permitting problems of a booming town, whether it slows them down or not, yeah, you're making a little bit more in the long run if the project takes longer. But at the end of the day, you have $14+ million that is only earning for you when it is deployed. And the day that somebody pays off that debt and it's back in your account, you don't stop having the shelf pressure of having to pay a return to your investors. And so you're motivated to turn around, get something underwritten, and get that back out the door as soon as possible. So from behind the magic curtain side of things, in terms of your scale and the ability to find people that are flipping deals in a tough market, like, is there risk there, or how is that side of the business looking for you, knowing that you're only hitting that 10% return and hopefully making the spread if you've got the capital deployed?
That's a great question. So it is one of the biggest challenges that we have as business owners of capital forecasting for the next 30, 60, and 90. It's not even 90 days. Really, it's 30 and 60 days for us. We're constantly looking down the road and saying, like, right now, I know off the top of my head, we have $1.93 million paying off in the month of December. And we have $2.3 million of originations in the month of December. But that is something that myself and the other business owner are always acutely aware of, because it is a balance that hard money lenders have to ride constantly. Now, the nice thing about the way we're structured is that we're collecting 12% from our borrowers and we're paying 10%. So there's a 20% mismatch there, which if we're running the business at full efficiency, we as GPs can capture that spread. But we also know that if we're not running as efficiently, that net income actually, gets squeezed down a little bit. So it really is something that it's a big part of owning a hard money lending business. It is something that we have been dealing with since the origination of the business. And it's just something we have to be hyper focused on. The nice thing I would say about being in a strong market like Texas is that over the last 7 years, deal flow has never been our limiting factor. Our limiting factor for the entirety of the business has always been, just finding and securing third-party capital. So, luckily, and we're part of a mastermind where we have, where we get together with the hard money lenders all throughout the U.S. And there are definitely markets that are having a lot more trouble with originations, but Texas is such a deep and big and growing market that we've been in good shape for deal flow perspective. In fact, this might surprise you, but as of today, we're right at $20 million in notes funded. And to date, we have never spent $1 on marketing, never run Meta ads or Google ads.
Whoa.
It's just, yeah, I know.
Are we really 30 minutes into this and I'm just now finding that out? Okay. So how do you deal source?
So we've been doing it for 7 years. So we have really good contacts and reputation. The nice thing about the hard money lending space, I will say, is that if you treat people really well, you run a tight ship. Number one, you're going to maintain your current client base, the borrowers that are working with you. And then over time, they're going to introduce you to people as well. One of the best marketing things that's really worked for us is actually just calling some of our favorite clients that are out there and saying, hey, do you have a bunch of buddies that flip houses? Yeah, of course I do. It's like, I'd love to take you guys to a nice steak dinner. Let's all sit around the table. Let me introduce myself as a person. Let me introduce kind of a little bit of what we do. At the end of it, I'll send everyone just a sample term sheet. And we've been able to generate a lot of business doing that. Just word of mouth, going to the RIA events. And so we do know that eventually, as we continue to grow, we are going to have to ramp up the marketing machine. We just haven't had to do so yet.
Good. So from the time that I present you, we've never worked before. From the time I present you a deal, how long does it take you to underwrite the property, and how many signatures are required on the paperwork?
Well, it's a lot of paperwork for them. But if you're coming to us and for a new borrower, now let me say this too, and this actually does tie into the risk protocol of the overall business. But the vast majority of our deal flow is repeat. flippers. It's guys who have been with us for 5+ years. They've been doing it for a long time. And the nice thing is, as their operation has grown, we grow correspondingly. So less of our business is really new, clients, new borrowers. But for a new borrower coming in, there's a lot of the standard documents that you would expect. It's I want you to give us the loan application, credit, full personal financial statement. We cross-check any of the properties that they have with county records. We want to take a look at bank statements and see if there's any liquidity concerns that we have. LLC documentation, just standard things like that. However, if they bring us a deal, they get us their LLC and personal documents very quickly. We could underwrite and fund within 48 hours.
Yeah. Speed's important to a lot of those guys.
It is, and it's the reason that why we don't compete with banks. A lot of people make the assumption that, well, hard money lenders exist because there's low quality flippers out there that banks won't give them money. And the reality is the majority of our flippers are 700 plus credit score. These guys are, hey, I got a bachelor's degree from XYZ University and I resigned from that because I like real estate more. They're professionals. And we don't overlap with banks because our underwriting and funding process is 48 hours. A bank is 4 to 6 weeks. We will take a look at distressed properties. Bank won't look at distressed properties. So there's virtually zero overlap between what we do and what banks do. It's just a totally different lending product.
Yeah, I love it. I mean, it's not rocket science. I've seen a lot of people enter into this space. A lot of times, though, deeper you dig, you find people are exposed. One place or another, you give all the money up front before there've been renovations get done. Somebody can walk away and leave you exposed if they never hit the ARV, and whatever happened in their personal life crumbles. Like it can be a problem there, and you have to create your own model that is protecting you and ultimately your investors. I've traditionally seen a lot of people start off a little bit more cavalier when it's their money. And then as they move towards accepting investors' money, you get pushed to having a lot of these stop guards in place to make sure that you're protected. And the only thing you can't control is the deal flow that's in the market. I mean, obviously that's not a problem right now. You've picked a great market. You're really well protected. Like even if you're at 70% of the ARV, if somebody bails like they did in August, okay, like you've got the opportunity to fire sale it and still make money, and your investors are never going to know. Right. So that's the key, is that it really comes down to how good is your underwriting and how well are you at protecting your investors.
Well, and let me expand on that if I could, because you're exactly right, Clint. When it was our own funds, we would actually lend up to 75% loan to value, and we were doing 100% financing. We were willing to move farther out on the risk curve, because we weren't a fiduciary at that point. Now keep in mind, the first people started investing with us were our parents. So that changed things substantially. And I mean, I don't mind saying, I don't think she'd mind me saying, my mother has her entire retirement with us. So she's living off of the interest payment that we're providing. She is one of our top 3 biggest LP investors in the fund. And so when you bring friends and family in, it completely changes the game. So we got hyper focused once we started bringing on outsized party. And over the course of the last 2 years, we actually went from an average LTV of close to 78% to today we're at 61.5%. So we got really focused on driving that loan to value down, because what that is that margin is your first line of defense if something goes wrong. It's like, hey, as of today, it's like I've got a 38% buffer there. That's really great. That's kind of first line of defense. The second line of defense for third-party investors is actually the way that we decided to structure the fund. So the majority of times when you look at the capital stack of an income or debt fund, you have the top line revenue that comes in, and then you have management fees and operational expenses, business expenses, miscellaneous. And then on the very bottom of the capital stack, you have the third-party LP investors. keep in mind, our LP investor group is friends and family primarily at this point. So we actually took that structure and we flipped it 180 degrees. So our top line revenue comes in. The first people that get paid out first are the third party investor base. It's only when they are first and fully paid out that I can even take a salary, that we can pay business operating expenses, that I can take a distribution, et cetera, as the owner. So, as an LP investor, the way is like, well, I have a first line of defense in that these guys are hyper focused on the underwriting and, lowering that loan to value ratio, which is great. The second line of defense that I have is like, these GPs aren't getting paid unless I'm getting paid. So, those two things. And again, that goes back to the whole ethos of saying, where do we lie on this investment spectrum? We want to be able to be justifiably close to as secure as a treasury or a money market. That's kind of the risk profile that we want to sit in. So that's how we decided to structure our funds, such that we kind of reflect that as well.
Well, I love it. I love it. It is more conservative than I've seen typical hard money lending. Like you said, when you guys started off, when it was just friends and families, you were taking bigger risks. And even today, I've seen income funds that people can invest in where it's not quite as conservative as you guys do. And I think that's very powerful. So, well, listen, David Little, thank you so much for sharing with us today. I've enjoyed this conversation. I know Clint has. I can see that he gets all excited. But if any of our audience wants to reach out to you and find out more about what you're all about, what would be the best way for them to do that?
Yeah, they could email me directly to david@crowncapitalresources.com. If you guys are okay with that, I'll put my number out there in the interweb as well. So my personal cell phone is 817-550-7328. And I'm happy to take a call, and either if you have just any questions, generally speaking, about hard money lending, if you're thinking about getting into the space, if you're thinking about being an investor, I'm more than happy to talk through anything and be a resource to people.
Last question, because we do have a bunch of flippers that are connected with our local alternative investing mastermind group. What markets are you serving? Is it predominantly just in Texas?
That's correct. Yeah. We only service Texas, loan sizes from $100,000 to $1 million. And, and it has to be a first lien position. So if it satisfies those three criterias, we're happy to take a look at it and provide a term sheet.
It sounds great as a hard money option if that meets the criteria. It sounds really great as a hard money option if you're the LP investor looking to place capital somewhere. So I'm glad we got a chance to talk about both sides of that. So David Little, really appreciate it. Thank you for your time coming on. Thanks so much.
Thanks, Neil. Thanks, Clint. Appreciate you.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.